Gold's taking a serious hit, with $2,600 now locked in as the bear's next big target. What's fueling this major price drop, and how long could this selling streak keep up? Get the inside scoop in this episode of As Good as Gold. Greetings, fellow traders. I'm Dillian, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Over the past week, gold bears have really taken control, and the selling pressure is quite obvious. In the short term, institutional sell-offs and the stronger dollar have been putting a lot of pressure on gold. On top of that, the slowdown in central bank gold purchases is limiting gold's upside potential. I still think the structure of Congress is something to keep an eye on, and this week's US CPI and retail sales number could add some volatility to gold prices. So in today's video, I'll kick things off with a technical analysis as usual, then dive into the reasons behind the strong bearish trend, and finally share my thoughts on where gold might be headed. Let's jump right in. Looking at the gold against US dollar daily chart, even though bulls tried to push prices back to $2,700 the day after the election results came out, they couldn't really turn the downtrend around. Last Friday, the price confirmed it had broken below the upward trend line since August and closed under $26.85. This level is a key spot because it's the 23.6% Fibonacci retracement from the August uptrend, plus it's also the September local high, making it a crucial battleground for bulls and bears. This week, the bears pushed gold down by 2.4% in just one day, and it even dropped below the 50-day moving average. Well, all signs point to the fact that we might have to say goodbye to $2,700 for a while, at least until the buyers can reclaim $26.85. The 50-day moving average above is also a strong resistance. And for the bears, $2,600 doesn't seem too far off. I'm actually feeling more concerned about gold now compared to last week, when I thought it could still consolidate in an elevated range. What really changed my outlook was the increased sell-off by large institutions. Since November, the world's largest gold ETF, SPDR, has been steadily reducing its gold holdings, and after the election, the pace has picked up. Plus, with gold breaking below key support levels, a lot of trend following and, momentum funds have been unloading the positions, making it quite tough to go long in the short term. Also, Trump bringing trade protectionist Robert Lighthizer back as U.S. trade representative has added to market bets on stronger tariffs, higher dollar demand, and rising inflation as well. Risk markets are booming, with the dollar index bouncing back above 105.5 this morning, and now there's a growing chance that the Fed will hold off on rate cuts in December. In this chart, the blue line shows the dollar index and the purple line shows gold prices. We can clearly see that for the first time in months, the strengthening dollar is pulling gold down. At the same time, with gold prices having risen so much, central bank purchases, which has been a huge driver for gold, is slowing down. According to the World Gold Council, global central bank net gold purchases in Q3 dropped as much as 49% year-on-year. The People's Bank of China has paused its gold buying for 6 straight months and clearly focusing on other priorities. With this happening, it's going to be harder for gold to rise further. So all in all, the market narrative has shifted from risk-off and hedging uncertainty to a more dominant America First view. With institutions selling, the dollar strengthening, and the central bank slowing gold purchases, I'm personally not too optimistic about gold's short-term outlook. That said, the worsening US debt situation and potential impacts from immigration policies on the job market could potentially give gold some support in the medium to long term. For now, while the Republicans are likely to win the House, which makes these policy plans more likely to happen, I would say it's still quite a risk until the results are finalized. Looking ahead for the rest of the week, tomorrow's US October CPI and Friday's retail sales data are key. The consensus is that core CPI will remain flat with a 0.3% month-on-month increase, while retail sales are expected to cool slightly from 0.4% in September to 0.3%. Since the Fed is hinting at slowing the pace of rate cuts, I think the market will react more to data that beats expectations. If inflation and retail sales both come in stronger than expected, the dollar index could test 106, continuing to put pressure on gold. If the data comes in as expected or even slightly weaker, we'll need to watch how gold reacts around the 50-day moving average. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data and events might impact gold trading, drop a comment below and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!